From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. So euphoria is interrupted temporarily. We've got the chips under attack. They're lower this morning by Intel, down. Nasdaq under pressure. We'll discuss the chips issue. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, stocks take that breather after the best week of 2024. Boeing CEO steps down. The fallout grows over safety issues, and Goldman's mega cap bull case pushing back against the warnings of excessive exuberance. We begin with a big issue. Have stocks run up too far, too fast?
This is starting to possibly be reminiscent of the 1990s. And if you ask me where we are in the 1990s, I think we're at December 5th, 1996, where Alan Greenspan asked, how do we know if it's irrational exuberance? And I'm concerned that the market would go up too fast. I mean, it's great on the way up. Melt-ups are wonderful, but by definition, they can lead to meltdowns. And so that's where my concern is.
Joining us now to discuss it is Cameron Dawson of NewEdge Wealth and Nadia Lovell of UBS. Thank you so much for being with us. Cameron, to you first of all, is it 1 minute to December the 5th, 1996?
Well, certainly we've had this massive move that has pushed valuations up to 21.2 times forward, which is pretty extraordinary because the only times we've seen valuations higher than this were during COVID and then during the tech bubble itself. So when we think about this market, I think we have to have two minds. One is respecting the short-term momentum. We're seeing things like breadth improve. Typically, breadth isn't improving into a market top. It tends to deteriorate as the market is nearing a top. So the opposite now is happening. But then also realizing that things like positioning, sentiment, and valuation are all very stretched. The challenge with those, they're very poor timing tools, and they need some kind of catalyst to cause an unwind. So it really is that short-term momentum countered by the fact that medium-term measures are stretched.
Nadia, good morning. There's a very sort of stability-orientated view. Give me yours. I mean, Ed, being very concerned that it is reminiscent of the 1990s, yet everybody comes in here and they tell me the earnings will sustain and maintain the drive higher in stocks.
Yes, I mean, we are sort of have a more balanced view right now on the markets. I mean, coming into the year, we were quite constructive on markets, and markets has been performing better than our expectations. I mean, already at our year-end price target. So it does suggest that there's a certain level of productivity increases that's being priced into the market given where valuation measures are. But that said, the economy does remain in good shape, and earnings revisions are happening. It also suggests to us that, you know, with this economy continuing to chug along and financial conditions are likely to ease further, the Fed has already hinted that there are interest rate cuts on the horizon. It feels like the path of least resistance for stock is up. And then you have, you know, a pretty low volatility environment, both from an equity standpoint and a bond standpoint. So it does suggest that that supports risk on, and there are dip buyers in the market. And so it feels that even if we do get some kind of some consolidation from here, that it's likely not to last for very long, nor be very deep.
It's interesting when you listen to some of the more veteran speakers in the market, the likes of Bill Gross talking about buckle up for excessive exuberance. You mentioned Fed speak, so let's just dig a little bit deeper into that pipeline. The latest from Raphael Bostek saying this: the economy continues to deliver surprises, and it continues to be more resilient and more energized than I had forecasted or projected. And as a consequence, I've sort of recalibrated where I think it's appropriate to move. Mike McKee is with me. So is this a missive, a message from Bostic, a subliminal message, or is it a lone ranger who wants to move to one cut, Mike?
Don't know if he's a lone ranger because there are a couple of people who have moved up the Fed dot plot. Raphael Bostic now says just one cut this year. He made those remarks on Friday and repeating them again this morning as we get into Fed speak post-meeting time period. We've got a number of Fed officials speaking today. Austin Goolsbee from the Chicago Fed comes a little bit later. And then Lisa Cook talking about the dual mandate. She's a governor on the board. We don't have a lot of economic indicators this week. We have new home sales and durable goods orders coming up. But Wednesday, Chris Waller, everybody follows him to see what's happening. And then Friday's the big day. Friday, we get the PCE inflation report that everybody cares about, particularly the Fed. And then we get Jay Powell's reaction to it, and nobody's going to care because the markets are closed and everybody's going to be on holiday. It's a very weird calendar schedule for the week, but I guess a week from today we'll be talking about it. We are expecting the personal income and PCE inflation report to come out and show that incomes increased, which increased spending, and the headline PCE and the PCE core remain relatively strong. They're much lower than CPI, but they're still in the mid-twos, so the Fed has a ways to go there. And I might mention, Manus, because you brought this up with the subject of your program today being the stock market continuing to rise. That's one of the inflation problems we have. Take a look at PCE inflation, and it has been heavily influenced by the market these days. You can see the blue line is the PCE inflation that's been rising right along with the S&P 500 because those fees continue to rise and commissions continue to rise as the market continues to go up. So I call it the pogo problem. We have met the enemy, and he is us.
Never deprive a broker of a decent-sized ticket with a bit of commission. That's from a veteran. Mike, thank you very much. Mike Vicky, setting out the agenda for the week. My guests this morning are Cameron Dawson and Nadia Lovell, still with me. Cameron, you would say time to roll out the five-year break-evens and walk in and just put it on the desk in front of Powell and go, what are you going to do there, buddy?
Yeah, this is so very important because he talked about inflation expectations being anchored. But if you look at those market-based inflation expectations, they have moved significantly higher this year. Now, some of that is from oil prices, from gasoline prices, mostly on the shorter end of things where there is a high correlation. But it speaks to the fact that there are some underlying inflation dynamics that are causing a reacceleration. Now, Powell was really eager to write off what happened in January and February with the CPI. The question is, if that trend continues of hotter inflation, will that really give the Fed the degrees of freedom that it would like in order to cut rates? And we think that the risk is that it doesn't, which just means that Bostic may prove to be correct with just one cut or fewer than 3 cuts this year.
It's only going to be interesting. I mean, we were neurotic whether we go from 3 to 2. That event didn't happen in the dots, did it, Nadia? I was reading Torsten Slock's research this morning. He talks about sticky wage inflation. The New York Fed, this was actually quite shocking. The New York Fed model has 5% on wage inflation. That is a country mile, or in American speak, that's 3% away from the target. So, Nadia, when you look at the break-evens, when you look at the Fed model when you look at the New York Fed model on wages, are you still convinced that we get 3?
I think so. I mean, our core view is that we get 3 cuts this year starting in June, and that's sort of been our core view since late last year. It depends on which sort of wage growth measure you look at it, because, you know, ECI is suggesting a different number, that you're closer to that 3.5% that the Fed wants to see wage growth that's consistent with its 2% target. But I think, you know, as Chairman Powell noted last week, there are going to be bumps along the way, but our core view, as long as inflation remains on the path back towards 2% over the projection period, that's what's really important for the Fed. And, you know, the fact that they did revise up their core PCE number while still maintaining 3 cuts does suggest that the Fed is willing to tolerate a bit of a volatility around inflation, and the Fed wants to cut and really stick that soft landing that's within sight. I mean, the fact that you have core PCE for this year and their projection at 2.6. That's not far off from, the 2.8 measurement that we got recently in our expectations for this Friday. We know that the Fed put is in play, and so that should be supportive for markets. And, rates volatility is coming down, and so that does provide a floor for equities in our view.
I'm just curious what you would both say to Goldman Sachs. They have they've looked at various scenario analysis. They've talked about 6,000 as being a target that's on the table. But this goes back, Cameron, to your point about breadth. They say breadth is being weighed down by the higher for longer narrative. You're saying to me that you are seeing breadth. Where is it most prominent? And is there some kind of a rotation from growth to value, or is that too extreme a nuance?
Yeah, there's a hint of the growth to value rotation, but it's important to add the cyclical aspect to it, because where we've seen the most improvement in breadth in the recent weeks has been in the most cyclical sectors. So your industrials, your materials, your energy stocks. We think some of this is sniffing out the fact that, yes, there's some underlying inflation dynamic, mostly in those commodity sensitive areas, but there is also a recovery happening in PMIs, in manufacturing PMIs. We think this economy actually has a cyclical recovery that is at play right now. Part of that is because of fiscal spending and all the spending on manufacturing construction. But there's also this dynamic that you were in a manufacturing contraction for much of the last 15 months. So as we see that cyclical recovery, that should cause growth to be better. The most incredible thing here, though, is that the Fed has actually never cut rates in the last 40 years when PMIs were accelerating or expanding. So talk about a first time for everything. This could be the first time that the Fed is cutting rates as we're seeing an improving PMI environment.
That's the holy grail, really, isn't it, Nadia, for this market, in that the expansion in profits, the expansion in markets, and yet people have said to me, as far as AI is concerned, Europe and the rest of the world is in the foothills of electricity use and data use relative to the US.
Yes, sort of our view in terms of, I agree with Cameron in terms of the cyclical recovery that's happening. This is one of the reasons why we've been favoring industrials, and we're seeing an improvement in breadth. You do have nearly 80% of the S&P 500 companies now that are above their, 50-day moving average. In terms of sort of like the expectations around AI and data and electricity, the infrastructure continues to be built out for AI. There's more to do, of course, in terms of on the utility standpoint. You're seeing some opportunities there as well. We continue to like tech because of this. We have some selectivity within utilities. Overall, we are underweight utilities, just given the fact of the defensive exposure in this sector. But we do think that there are opportunities from those that could benefit from the continued pickup in data centers and AI. I would say, just to finally send home that point, our focus in tech also has expanded beyond the U.S. We have been encouraging our clients to also look outside the United States, particularly in Asia. Asia Super 8 is a group of stocks that we are looking at in terms of exposure to AI from a semiconductor standpoint, as well as an AI application standpoint.
Okay, Cameron, thank you so much. Nadia, thank you. Both stay with me, Nadia and Cameron Dawson there. Quick snapshot of what's going on in the commodity market as well. There's a big note out from Goldman Sachs today talking about the next evolution, another 15% upside in commodities for 2024. And they specifically cite copper, aluminium and gold, as well as oil products. They see, gold has hit a record, and copper obviously topped at 9,000. This is on COMEX. Of course, on the LME, it trades at $9,000, and their price targets are for the various areas. Copper at 10,000, aluminium 2,600, and gold at $2,300. So just keep that in the back of your mind as well. A couple of lines coming through from Austin Goolsbee. This is on Yahoo Finance and an interview there. He's saying he doesn't feel like the story has fundamentally changed at the moment, that they need to see progress in the inflation coming down, and that the main puzzle with inflation is in the housing market. So as those headlines evolve, we'll bring those to you. Let's get under the hood. What's moving ahead of the bell? We had those chips under pressure at the start of the session. Abby, what have you got?
Lots of chip pressure indeed, but we also have lots of news on the airlines. Let's start off on the shares of Boeing, because they are higher, at least the last time that I looked. And this, of course, on the news that CEO Dave Calhoun is out. The hope that the issues investors hoping that this could bring the issues that we've had with the Boeing planes, the 737s in particular, that perhaps it will get worked out. United Airlines, though, down 3.1%, and this is a Bloomberg scoop. The FAA is considering temporary measures to curb growth, including preventing them potentially from adding new routes. This after, of course, a series of safety incidents. And then you were talking about the chips, Manus. There's AMD down 3.6% on this report that China is going to limit the use of foreign chips.
Okay, yeah, big news flow on those airlines over the weekend and this morning. Abby, thank you very much. Coming up, we're going to dig into the Boeing CEO stepping down.
I didn't know what happened to whoever was supposed to be in the seat next to that hole in the airplane. I got kids, I got grandkids, and so do you. This stuff matters.
That was David Calhoun, a passionate plea at one stage. He's to step down at the end of the year. The stock is up nearly 4%. We discuss on Bloomberg.
I didn't know what happened to whoever was supposed to be in the seat next to that hole in the airplane. I got kids, I got grandkids, and so do you. This stuff matters. Everything matters. Every detail matters.
That was the CEO, Dave Calhoun, back in January. Now Boeing announcing sweeping management changes, with Calhoun set to leave the company at the end of the year. Now, the airplane maker is grappling with safety crises centered around its most important product, the 737 MAX jetliner. A line from the outgoing CEO, he will be there until the end of the year. He said, "The eyes of the world are on us." This is from Calhoun himself, as he will leave at the end of the year. As you all know, Alaska Airlines Flight 1282, the accident was a watershed moment for Boeing, and we must continue to respond with humility. Let's get to our Bloomberg reporter on the story. It is Sid Phillip. Sid, good to have you with me. I mean, one could say there was an inevitability to this. Are you surprised that he's going? Are you surprised that he's staying until the end of the year?
Yeah, I mean, it has been, there's been speculation for some time now that Calhoun and Standeel, who leads Boeing commercial airplanes, could be sort of they could be removed from their positions because of the crisis that's ongoing at Boeing. But sort of matters came to a crescendo last week when airline CEOs sought meetings with the board without the presence of management, and that sort of set off alarm bells ringing that something was in the offing. But this is a massive move for Boeing to sort of do such a massive regulatory shakeup, and it sort of comes at a time when the company is in its biggest crisis since the MAX crashes back in 2018 and 2019.
Okay, well, it is breaking news, and the stock is rallying ahead of the open. Sid, thank you very much. Bloomberg's Sid Phillip on the airlines. My guests this morning are Cameron, Dawson, Nadia Lovell on this topic. I'm drawn to one line, Cameron, that the CEO said, "We are going to fix the problems, but we must inculcate commitment to safety and quality." That is perhaps the most shocking statement of all. We must inculcate commitment and safety. One would presume it was there. An inevitability, what does it take for market analysts to believe in Boeing again?
Yeah, to your point, you would have hoped that this was there. And this really does speak to what are deep-seated cultural issues at Boeing that have been around for quite some time. It started in the Muhlenberg years with that laser focus, singular focus just on cash flow, which of course was curtailed with the two fatal 737 MAX crashes. But the replacement with Calhoun was effectively an insider. He'd been on the board for a while. He also came from GE, which shared a lot of the same cultural issues as Boeing, which is a deep chasm between the corporate oversight and manufacturing boots on the ground. So GE's issues were fixed with an outsider in Larry Culp. The question is, what kind of outsider is it possible to have that at Boeing? So we see this as a step in the right direction to change management. However, it's likely a very long and winding road to fix these cultural issues, fix safety issues at Boeing.
And Nadia, if I take it to you in a slightly broader context, departure of a CEO, the wholesale overhaul of Boeing. When you look at the overall airline space, I have the consumer demand rampant in the front end of the airline, but we have fundamental safety issues in some of the biggest producers in the world. Your first take on the CEO stepping down at Boeing?
Sure, we think that it's important that we continue to take the safety issues seriously and shore up our safety system so that, one, consumers as well as investors have confidence in our industry. We know that there's strong demand for aircrafts and the pipelines are quite robust, but we want to make sure that those aircrafts that's coming out and coming to market are safe. I mean, more broadly in the airline space, this is an area that we're more neutral on. Obviously you've highlighted the pickup in consumer travel that's likely to extend into the summer season, and there's probably going to be capacity issues, and so that probably helps price in terms of airlines. But reality is we're also watching, of course, the pickup in energy prices because that will be a headwind from a cost standpoint.
Ladies, great first reaction to the breaking news story and your take on the market. Cameron Dawson, Nadia Lovell, my guest this morning. Coming up, your morning calls, and later we'll have SocGen's Manish Kabra with me to discuss why he thinks the U.S. economic narrative is beginning to improve. The conversation on Bloomberg this Monday morning. Euphoria is temporarily interrupted. I mean, we've come up the best week of gains, up nearly 3% on the Nasdaq last week. It is interrupted temporarily. You've got AMD and Intel under pressure, more than under pressure, as we understand that China are going to push back against using those chips in government servers. Again, it's getting embroiled in that tit-for-tat trade war. Stocks are just drifting a little bit lower. You put on nearly 3% on the Nasdaq. Yeah, so you roll it over, have a look at the bonds, because what you've got here, we're counting down to the PCE. Yes, the core will come in, they expect, at 0.3%, so a little bit of a nip lower there. But again, we drifted lower. We took 10 basis points off the short end of the curve last week. So yields just ticking back ever so slightly. Let me get you up to speed with your morning calls. This is what you got this Monday morning. What is Wall Street writing about? Well, first up, Barclays upgrades Disney to overweight, citing a narrative reset, which likely will be followed by a positive estimate for revisions. Next up, Mizuho downgrades Tesla to neutral, analysts citing challenges like weakening demand, tightening liquidity through next year. And finally, Wells Fargo raises the price target on Citi to $80 and keeps an overweight rating on the shares. The analyst cites optimism about the bank's restructuring. Monday morning, we're going to reset your agenda again. We've got SocGen's Manish Kabra joining me on why the macro themes, they're improving. That's all around the opening bell. That is up next on Bloomberg. Good morning from New York. Equities kick off the week. We're going to roll over from futures to cash in just a moment. On the back foot, two very, very clear agenda issues for us this week. One is the pressure on chips coming from China in AMD, along with Intel, but also the regulatory angst as well from the European Union. That Digital Markets Act is going to get its teeth into tech, in Apple, in Meta, etc. So these are new headwinds in tech. But again, the market believes you're going to get this 3 cuts. And so we've just heard from our guest this morning talking about breadth. The Russell 2000 futures up 0.3%. There you go. You got the asset managers rejoicing over at the NYSE with Eaton Vance. This is the state of play. You got the euro up by 0.2%. Yields managed to regain 2-3 basis points. It's hardly what you call major moves on that. As you saw last week, 2-year yields, I should say, down by 13 basis points, and the 10s were down by 10 basis points on the week. Crude is up 0.8%. The market presumes that OPEC Plus will continue with their cuts and that there's no need for a policy response at next week's meeting. So let's stay to play across your assets this morning. There is only one dominant story. It is about Boeing. The CEO, David Calhoun, announces he will step down after the fallout from the safety issues around the 737 MAX jetliner. Abigail Doolittle is with me on the story. Abby, what advances in this story have we got? Calhoun will go, but it won't be until the end of the year.
Yes, and we do have the stock popping. In fact, the best day since January on this, Manus. Investors very encouraged by the idea that by Calhoun stepping down, that perhaps these issues, these manufacturing and supply chain issues that we've had with Boeing that have caused a number of tragedies for, in particular, the 737 line, although there was an issue not so long ago with the 777, that all these issues will get worked out and that these planes will be safer and there will be more confidence. But it's not just Boeing that's in the news this morning. And I should mention, actually, because it's very interesting in terms of airlines using Boeing planes, United is one, but we also have Ryanair. Their company, the CEO there, is welcoming the management changes in CEO, saying that they really welcome the immediate management changes, that with Stephanie Pope being appointed to lead Boeing commercial airplanes effective today. So as you mentioned, Dave Calhoun, it's going to be a little bit while, but some changes happening today. So Ryanair expressing encouragement and support for that. On the other hand, we have the shares of United Airlines, a big user of some of those Boeing 737 planes, one of the biggest users. Those shares are down, and this, of course, has to do with the Bloomberg scoop saying that the FAA is considering that they may, in fact, put in place measures that could slow growth, such as limiting operations on newly delivered jets and also not allowing new routes to go into play. This is important, Manus, given that the all-important summer season is ahead. So lots of news on the airlines today.
OK, Abby, thank you very much. Let's turn our attention to the chip makers I mentioned to you throughout the show. You got the Financial Times reporting this, that China is limiting the use of US chips in the servers on government computers. Ed is with me. Ed Ludlow is ever tracking the tech story. How significant is this, Ed, if there is a pushback from the Chinese government?
Well, significant in the sense that more than 25% of Intel's revenue overall comes from Greater China. What the FT is reporting is that the new guidelines from the Finance Ministry and the Ministry of Industry and Information Technology would require over time government entities to source both servers and other hardware where the microprocessors or chips are made by domestic manufacturers. Problem being that at the cutting edge of server GPUs and CPUs, those are mostly US players. Part of the FT's report also includes some software names, for example, Microsoft, which seems to be there seems to be a lower level of impact. But you look at the names involved, Intel and AMD. Intel down more significantly, almost 4%. AMD down 2.7%. I think you heard you say this earlier, Manus, but it is a sort of tit for tat. You know, the domain of server designs in the context of the chips that goes into them has become an economic hostility between the two nations. And you'll remember that last week Bloomberg reported that the United States is looking at Huawei in particular and some of the affiliate companies of Huawei in how they might be circumventing restrictions to get access to chip making equipment and chips that go into Huawei hardware. So it's a story that's moving at a daily and weekly pace, and it's not a huge surprise that the Chinese government's doing this in the context that they've already done it with bans on foreign laptops and smartphone handsets in the government entity use case.
Yep, and certainly just looking at the breakdown, I mean, you're looking at 14.7 billion in terms of revenue coming from China, which again is just ahead of the United States on the gross level. Ed, thank you very much. Ed Ludlow there tracking this story on tech. Let's dig a little bit deeper because you've got Apple, Google and Meta. They're also facing investigations. Now, this time it's from the EU and it's about their compliance with new laws. Alex Webb is with me. This is Europe gnashing its teeth, not just showing its teeth, but some force. Context for me, Alex. What is the new act and what are they pressing down on?
Well, this all pertains to the Digital Markets Act, which was passed in November 22, came into effect in May 2023. But crucially, the companies had to be following its dictums by March the 7th. And so now, very soon after that, as you say, the the EU is showing its teeth. This is about what it deems as gatekeepers. These are companies that match a certain number of thresholds, for example, having a market cap of more than $75 billion, having a certain number of users in the European Union. And it won't surprise you to learn that these are mostly Silicon Valley giant, or at least West Coast tech giants, Apple, Amazon, Microsoft, Google, Facebook, as well as, of course, TikTok. It's about trying to ensure that they don't have outsized power. And in this particular case, it's really targeting, certainly in the case of Apple and Google, what is called self-preferencing. This is where you have one service and you sort of force or encourage a customer to use another adjacent service. So in the case of Apple, it's quite hard to delete Safari from your iPhone. That is therefore perhaps considered self-preferencing. That is something the European Union is going to investigate. Needless to say, Apple denies that that's the case. Similar with Google, whether it serves its own search results, its own services in search results. And with Facebook, it's to do whether it serves data, it shares data between, say, Facebook and Instagram. So lots of different things, but quite precise for each of those companies.
Yep, and certainly it's going to be interesting to see then any more developments between Google, Alphabet and Apple in terms of the AI story. Alex, thank you very much. Let's turn our attention to entertainment space. Disney's getting an upgrade from Barclays into overweight, saying that the narrative reset should be followed by positive estimate revisions. Katie Greifeld has the revision narrative. What have we got, Katie?
Well, that vote of confidence from Barclays definitely supporting Disney shares this morning, currently up about 2.5%. To get specific here, Barclays upgraded Disney to overweight from equal weight. And like you said, the analysts there saying that Disney, it's undergone a, quote, narrative reset since its fourth quarter results. That should be followed by positive earnings estimate revisions. The analyst also says that, of course, better than expected 2024 guidance and what they call an incessant flow of Disney-related news ahead of its proxy vote. That should be a near-term positive for this stock. Additionally, investors have, quote, gained more confidence about earnings that these estimates have actually bottomed. Of course, Disney reported in February. The stock is up about 17% since then. And we heard from Bob Iger this month saying that he's extremely confident that the company will meet its goal of profitability in its streaming TV businesses in the fourth quarter. Now, the next thing to watch here, Manus, is the Disney's annual meeting. That, of course, happening in early April. And Disney, right now, it's embroiled in a proxy battle with Nelson Peltz. It will be fascinating to see the results of that vote.
Okay, Katie, thank you very much. Katie Greifeld tracking the Disney story. SocGen's Manish Kabra joins me now, weighing in on the markets. His view: U.S. exceptionalism is going from strength to strength. The macro themes continue to improve in the U.S. with the AI boom prompted our bullish view in June 2023, and now improving credit conditions and lending standards. Manish, good to see you this morning. You present a thoroughly rational proposition for continued, I would say, pretty strong bullishness.
Yes. I think it's fair. As in, we started upgrading S&P, view in second quarter, on back of Nasdaq, way before market started to coin this term Magnificent Seven. To be honest, we upgraded U.S. industrials back in November 22. So it's been a while on back of expectations there would be a strong fiscal response in the U.S. last year. Now, today's or last week, when we upgraded S&P target again, as in the whole, holistic reason is literally we got, the reshoring boom taking place. We got the AI excitement, Nasdaq earnings booming at this point. And then we have, very surprising, as in lending standards are getting way less negative. Credit spreads are saying, we are past the peak of the default cycle. When you combine those things together, we upgraded financials. And we upgraded financials for the first time since December of 21. So it's taken a lot of thinking, a lot of courage of going beyond than what we have been seeing for the last 2 years.
And that courage is emboldened in financials. And this is quite a call because you upgrade your financials call for the first time since December 2021. You're upgrading US financials. Now, do you dissect that? I mean, we're showing Citi, Wells, Bank of America, and of course there is the Godfather in the room. It'll come soon, JP Morgan. Where do you upgrade the most in financials?
As in, look, as in our preference is to go for cyclical growth. As in, that's really the big focus. Cyclical growth is the part of the market that we like. Within that, of course, both banks and insurance are attractive. They come, they tick a lot of our boxes that we want everyone to position for, in second quarter and rest of the year. So that's, both banks and insurance, are the big focus.
You also say the consumer is in boom phase. What is it that reassures you of that when I have others warning me? I mean, savings rate are not imploding as quickly as they have been. So why is it that you say we're in a boom phase?
Good point. Main reason is the housing data, house price data that we are watching. It's, it troughed in Q3 of last year. It's growing at plus 6%. At this point, U.S. consumer confidence again, So
does that deliver average. A wealth effect? Is that it?
Exactly. There's a very strong wealth effect, based on house prices, based on market prices. And then, you combine all of this together with the, the main thing is what leads uncertainty in the market, uncertainty in the jobs market is when profit margins start slowing down. At the moment, what we are seeing is, S&P, of course, it's, very strong balance sheet, companies doing really well. But even if you go economy-wide companies and you try to see where profit margins are, they're still way above average levels. So I think if profit margins don't wobble, we don't see employment shock, and all of that starts feeding into the expectations that we have that consumer will keep doing, keep surprising in the US on the upside.
In the target that you have, 5,500 for the S&P 500, and you obviously talk about the profitability within the NASDAQ 100 stocks, which is surged by 25% in profits. You strip out the NASDAQ components of the S&P 500, and you have a much different profitability story. When you look, and again, I asked you the same question as I asked the last cohort, which is AI. We understand the growth trajectory here in the United States of America measured by energy consumption, measured by the number of stocks. Where are we in the evolution of AI and those chip usage in Europe relative to the United States of America? Is that the next evolution of that chip story?
As in every corporate is, whether it's corporate, whether it's sovereign, as in everyone is trying to work out how to use this, the data centers, how to use the artificial, the idea of generative AI, how to start using that and start creating, productivity boost, at this point. So I would say, as in my take on AI is, yes, it started in the US. There are a lot of companies who are going to use it. We try to dissect that by who's going to use it, which country, which part of within the organization, who's really going to take benefit of that. And it's a very global phenomena. So as in it's again, Europe came up with the first, Artificial Intelligence Act. And whenever you have regulation coming into play, I would say that theme is maturing, it's getting accepted. And widely, getting recognized. So it is getting recognized around the world at this point.
Yeah, I mean, it's certainly a headwind this morning, isn't it, in terms of not just the tit-for-tat trade war, which is kicking in on Intel and AMD, but also the Europeans are setting their stall out in terms of they're going to take some big tech to task. Manish, thank you very much. Manish Kabra, Societe Generale, my guest this morning on The Markets. Coming up, the EU investigates those very big US tech titans.
These are serious cases. We've been able to solve that with merely a discussion. It would have been resolved by now.
We take a look at the probe on Bloomberg.
These are serious cases. We've been able to solve that with merely a discussion. It would have been resolved by now. So we open for good reasons, because we find that if this, in inverted commas, compliance solutions, if they persist, then consumers will not have the choice that they were promised by the Digital Markets Act.
Tech is under pressure this morning in the United States. Apple, Alphabet and Meta potentially facing hefty fines as the EU investigates their compliance with laws aimed at reining in the power of big tech. Meanwhile, you've got the Financial Times reporting that China is limiting the use of US-made chips and in the servers for government computers. We've got team coverage on these stories. They are moving markets. Mandeep Singh, Ed Ludlow join me now. Mandeep, let me go to you first of all. We've been talking about this issue in terms of regulation. It really is a mounting headwind, isn't it, from the Europeans?
Yeah, and look, they rolled out Digital Markets Act. Now they are looking into which companies are actually complying with it and who are not. And I think in this case, the challenge for an Alphabet or an Apple is because they own the operating system, the EU is going to look at them as gatekeepers of the internet. They have an app store where they charge their own commissions, and they want these companies to open up the app store for third-party payment systems, et cetera. So a lot of changes in terms of how these companies are supposed to open up the platforms. But in the end, it comes down to giving users more option. I mean, if you have to pay Meta not to track the user and subscribe to their services, how likely is that going to happen? But that's what I think we are looking at in terms of the changes these companies are about to roll out.
In terms of the fines, Ed, I will come to you in a moment just on the chips, but Mandeep, just finish off briefly for me in terms of the potential litigious fines, the scale of the fines. How much of a headwind is that? Is it a real headwind or a minnow?
I mean, what we have seen historically is if these companies are found not in compliance, they may have to pay up to 10% of their revenue in the region. So in the case of Alphabet, 30% of their total revenue comes from EU. So potentially we are talking about 10% of that 30%, so almost 3% of their revenue as potential fines. But I find it hard to imagine, these companies are totally not in compliance. They have been making changes to give user more consents. They've been opening up the platform to change the default. So they're already making the changes. Okay. I find it unlikely you will see hefty fines here.
Okay, Mandeep, thank you. Ed, good morning. Good to see you again. So when we grapple what's going on with the likes of AMD and with Intel, you look at this through the prism of what the US, the Biden administration, the Trump administration has been trying to do to restrict technology going into China. But yet on the other side of the trade, you would point out that this tit for tat is about the Chinese and their import restrictions.
Yeah, that is the policy balance, right? The United States is trying to curb export of proprietary technology into China, and China's response is to say, well, okay, then, if you are a government entity or a state-backed company, then we are going to limit your ability to import certain technology anyway. How this manifests itself from the point of view of the companies is really interesting. Overall, Intel gets 25% of its revenue from China. What we're talking about, according to the FT report, is the chips that go into government-used servers that power compute, or the servers themselves. The server designs are made up of GPUs, CPUs, networking gear, Ethernet, etc. And the guidelines from the Finance and the Industry and Information Technology Ministry basically say, from this point on, as you're buying computing equipment in the server context, we want you to use domestic players. The problem that the Chinese have got is they don't have Chinese domestic players at the cutting edge of semiconductor manufacturing. And so if this is about AI or it's about the sort of edge case of compute, they're still kind of beholden to those US companies for the time being.
Okay, Ed, we'll see where this goes to. Ed Ludlow, tracking the chip story. Thank you very much. Some sector price action this Monday morning as we start into a shortened week of risk-taking and counting down to the PC. Abby's side by side with me.
And right now we do have a small decline for the S&P 500, but nonetheless, more sectors are higher than not, led by energy, up 1.1%, despite the fact that we do, I should say, in sympathy with oil being higher. Brent crude by up 1.2%, WTI up just a little bit more. Real estate, materials, healthcare, utilities, consumer staple, and discretionary higher. A lot of defensive sectors in there. So in some ways, there's a little bit of a risk-off tone. To the downside, tech and communication services, both down more than 0.6%. Let's look at some of the subsectors that are really under pressure today. And not surprisingly, with all the talk about chips and the possible limitation on China of foreign chips, we do have the stocks down more than 1%, and the airlines down. Actually, the stocks off of its lows, down 0.6% at this point. The S&P 500 airline index down 1.2%, being weighed on largely by United Airlines. And of course, that Bloomberg scoop that the FAA may in fact require them to limit growth in particular ways.
Yeah, we're certainly going to look at, supply and into the airline system this summer. It's going to be tight. Abigail, thank you very much. Abigail Doolittle on your sectors coming up in the show. I'll run you through your agenda for the week. The trading diary, it's on the way. Let's get you your trading diary for this week. Today, it is the deadline for Donald Trump's $454 million bond. The Milken Investor Conference kicks off tomorrow. We also have U.S. mortgage applications coming through on Wednesday. Thursday, Sam Bankman-Fried is scheduled for a sentencing in New York. And finally, we close out the week with the PCE data and the Fed Chair Jay Powell speaking in San Francisco. Markets will be closed for the Good Friday holiday. The only thing you could trade that day is Bitcoin. That was Countdown to the Open right here on Bloomberg, setting the agenda for you this Monday morning. Good morning from New York.